Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem S15-11 from the textbook, or the workbook, sorry. Now, you might be wondering, Kyle, what the heck is going on? You just said S15-11, but what you have over here is the problem for S15-10. And you're right, often I don't know what's going on, but in this case, this is intentional. The reason being, I think that it is beneficial for us to understand the straight line amortization method comprehensively prior to digging into something a little bit more advanced. So I want to review a few topics from S15-10 before advancing to S15-11. So there is another tutorial on how to do S15-10. If you haven't watched that, I would recommend you go back and watch that prior to watching this video, because this video just has the ending solution, which is here. And all S15-10 asked us to do was payment on the semi-annual interest payment on July 1st. That was this entry here. But because this was the straight line method of amortization, the journal entries every period are going to be exactly the same. And by exactly the same, I mean it will be the same accounts in the same amounts. The date will change. But I want to take a minute and just go through a couple of things here. So we have this bond payable account. We know that that's a liability on the balance sheet, and we have this premium on bond payable account. This is a companion account to the bond payable, which means that these two added together are the carrying value of the bond. So the carrying value of this bond is 400,000 plus 424,000. And then what we do here in the straight line method, we calculated the interest expense in S15-10 of $12,800. So that's the same. And that's going to be the same every journal entry. So if the interest expense is $12,800 and we divide that by the carrying value from the prior period, so that's the 400,000 plus 24,000, we get what interest rate is implicit in our interest expense journal entry. So that is math beyond my brain to do in my head. So I'm going to 12,800 divided by 400 plus 24. That's 3.0189. That's 3.02%. Now, if I were to do the same thing with the December journal entry, so remember the interest expense doesn't change. So it's going to be 12,800 divided by the face value of the bond payable plus the companion account, 24,000. We need to actually deduct how much we lowered it by in the previous period. Remember, we lowered it by debiting it in the prior period. We lowered that premium. So I'm going to lower this by the premium, because that's going to be the net carrying value after we did that journal entry. So if I were to do this calculation, and I'm going to have to do that in Excel, it's going to be 3.0, and this time 3%. So the interest rate implicit in our journal entry is changing. It was 3.02, now it's 3.03, and when we move forward in the next period, it will be different. It will increase again. Now, how can that be possible? I've told you before in class and throughout these tutorials that the coupon rate on a bond doesn't change. So why is the interest rate changing? And that would be a very astute observation of you to make. It doesn't change. This is a weakness inherent with the straight line method of amortizing a bond, payable or a bond premium. So in order to combat that weakness, there's another method, the effective interest rate method, in which case the interest rate implicit in our journal entries will be consistent. So that's what S15-11 is all about. So let's move on to there. So we have S15-11 now. Marley's Incorporated issued a 1.5 million, 6% 10-year bond and received cash proceeds of $1.3 million. So they received less cash than the face value of the bond. How could that be? Well, remember, when market interest rates decrease, bond prices increase. So this is what's known as the inverse relationship between interest rates and bond prices. But here, the bond price was actually issued lower, which means the interest rate must have increased. So that means that it was issued at a discount because the cash proceeds was less than the face value. So what do we know? What else do we know? We know the market interest rate on the date of issuance was 7%, and it pays interest semi-annually. So what do we need to do? Well, part A is, did the bond sell at a discount or premium? Whenever the bond price is less than face value, it sells at a discount. So that's part A. That's fairly easy. And that is just a way to express the inverse relationships that bond prices and interest rates have. Now, in doing this, I'm going to do part B and part C together. Part B is to prepare an amortization table, and I have a template for us set up here. And part C is to do, I think, the journal entries, and I have a template set up for us here. So I think I'm going to do the journal entries first, and then post those journal entries to the amortization table. However, despite that, I think maybe it's beneficial just to put in our beginning balance into the amortization table before we do the journal entries. So on the table, what it's asking us in this first line is, well, on issuance, what is the bond carrying value? Well, I know they issued the bond on March 31st, 2020, and they received cash proceeds of $1,393,407. I got that amount from the question stem. That's the carrying value of the bond on the date it was issued. It was issued at a discount, which means they need to amortize that discount over the life of the bond, over the term of the bond, which means that the unamortized amount as of the date of acquisition is going to be the face value, which is $1.5 million, less the carrying value. So looking at that in a journal entry format, think about, well, what happened here? Why do organizations even issue bonds? They issue bonds to raise cash. So cash here we know is going to go up. So I'm going to debit cash. And I'm going to debit cash because they received $1.3 million, because that's the cash proceeds of this bond issue. So what else is happening here? Well, I know that bonds are kind of like big IOUs. At the end of the IOU, or at the end of the term of the bond or the corporation, the borrower, they have to pay the lender, the bond holder, the face value of the bond. So they're going to have a liability in the amount of the face value. So I'm going to set up a bond payable, $1.5 million. To balance my journal entry, what I need to do is have this discount on bond payable. And that's going to be the difference between these two. And this should match what we did in the amortization schedule. Hopefully it does. 106, 106. Okay, perfect. So this 106,000 needs to be amortized over the term of the bond. And it will be amortized in a way such that the carrying value of the bond increases to $1.5 million. Right now, the carrying value is only $1.3 million. So this discount on bond payable, this account here, this is a contra account to the bonds payable account. It offsets the bonds payable account. So right now, there's a credit balance in bonds payable of $1.5 million. Since this discounts account is, well, a contra account, it has a debit balance and it offsets that credit balance. So that's March 31st. Let's fast forward 6 months. We'll do the journal entry for it. 6 months later, it's September 30th, 2020. What's going to happen here is we know there's going to be an interest expense. We're going to be amortizing a part of this bond payable, bond payable. And we're going to be lowering cash. Now, the amount that cash is going to be lowered by is going to be dictated by the coupon rate and the face value. So the face value of this bond is $1.5 million. The coupon rate is 6%, and interest is paid semi-annually, which means we need to prorate it to 6 months of the year. That's going to equal something that I'm not capable of doing in my head. So 1.5 times 6% times 6 divided by 12 is $45,000. That's the total interest payment in our schedule. Let me just clear this up so I have more room to work with. But that's not the interest expense to this corporation as of September 30th. With the effective interest rate method, the interest expense is dictated by the market interest rate, not the coupon rate on the bond. So the market interest rate here was 7%. So if I take 7% and multiply that by the prior period's bond carrying amount, which is $1.3 million, and then prorate that to 6 months of the year, I'm going to get the interest expense to this organization. And I'll do that again using a formula in Excel. $48,000. I should have done it directly in this cell here. I'll just copy and paste it in. And actually what I'm going to do instead too is erase 1393 and reference this cell. Perfect. Okay, so that's the interest expense here. That would be the income statement expense. This is what would be recognized on the income statement in impact profit. So since I know I'm making an interest payment here, I'm going to recognize an interest expense in that amount. But you'll notice that these two are different. Since these two are different, we're actually going to be amortizing part of the unamortized discount balance. So I'm going to jump, I know I'm going back and forth here, I'm going to jump back to our journal entries. When we're making our interest payment, I know the amount of cash that's being paid to bondholders is dictated by the face value as well as the coupon rate. And we calculated that here, the 45,000. So that's how much cash is actually going to be decreasing by. Means when we're amortizing the discount balance, I need to do that through a credit to balance out my journal entry. So these two values should match. And they do. Perfect. So this discount on bonds payable, this is going to lower the unamortized discount balance. So it was 106,000. Now we've just lowered it by 3,769, which means the unamortized amount is 102,824. Well, why is it lowered? Because this discount on bonds payable account is a contra account to the bond payable. So discount bond payable, if I were to look at this in a T account, it was originally had a debit balance of 106,593. Then we just credited it by 3,769. So after that credit, it's going to have a debit balance of 102,824, And this is the amount that we still need to amortize over the bond term. Just want to make sure I have a clean sheet. Okay. So since the contra account is lowered, that means the bond's carrying value is going to be increased. This is going to be 1.37 million, or 1.397 million now, sorry. Okay. So Part B just wanted us to do the first two interest payments. So what we'll do, March 31st, 2020, the interest payment we know is going to be exactly the same. It's going to be $45,000. Remember, that's dictated by the coupon rate as well as the face value. And we'll go through the journal entry as well. Journal entry, it's going to have the same accounts. So I'll copy and paste those down. And the interest expense is going to be the prior period's bond carrying amount, so 1,397,176, multiplied by the market rate, which is 7%, multiplied by 6 months of the year. So 48,901. Which means that part of the discount that's get amortized has also increased. The on-amortized amount has decreased, but the bond's carrying value has now increased. So to populate my journal entry, I'm going to just take amounts from the schedule. The interest is going to match. The amount we amortized is going to be here. We're going to be crediting that to lower our contra account. And cash is going to be decreasing by the interest payment. This is the amount that's actually going to the bondholders, going to the lenders. So you'll notice here, the interest expense amount is decreasing, or sorry, increasing, but the bond carrying value is also increasing. That means that the percentage of interest expense is going to be consistent throughout the life of the bond. It doesn't increase as it did with the straight line method, and that's why I wanted to introduce this problem by doing the straight line method first. And this is all that this is asking us to do with regards to part A and part B, and even part C, but I want to just move forward with part B because I'm in the luxury of Excel. I just use formulas in order to do this. So I can copy and paste this down. A little tip here, if I want to add days together, I can do a formula. So if 6 months later is going to be 365 days divided by 2, and I'm off by about a day or so, but for purposes of demonstration here, this is close enough. I want to go forward and complete this schedule. So it was 10 years, a 10-year bond, which means 20 interest payments. So I'm going to just complete the schedule. I went a little bit too far. Okay. So 10 years later, we can see that because we amortized the discount, the unamortized amount reduces to 0, and the full carrying value of the bond at the end of the 10 years is $1.5 million. And that's going to be the amount that this corporation will be paying to its lenders because that was the face value of the bond, even though they only received $1.3 million in cash when it was originally issued. Okay, so that's parts A, B, and C. Part D is if we were to amortize the bond discount using the straight line method instead of the effective interest rate method, record the first interest amortization entry. Okay, so I'm just going to copy and paste this template down. So the first interest payment is going to be on September 30th, 2020. And I know it's going to be the same accounts: interest expense, discount on bond payable, cash, cash is going to be going down by 45,000. That's not going to change. In order to do this calculation, it's just going to be a constant rate. So the overall discount on bond payable was 106,593. Now, this is a 10-year bond, but interest is paid semi-annually, so divided by 10 multiplied by 2 is going to be 20. So 106,593 divided by 20 is going to be 5,329. Which means that the interest expense, in order to balance out my journal entry, are these two added together. And it would be this amount of interest expense every transaction if it were the straight line method. And that's part D. So again, this was S15-11, starting with a little bit of S15-10 from the Pearson textbook. I hope you found this tutorial useful. My name is Kyle. Have a great day.